Now, as we go into the refined product world, we always start with the summary of looking at what is happening at the moment. And one of the things that we've been talking about is that we were going to fall just below the 2021 average. And you can see that there was those spikes. A lot of that was driven based on some of the gasoline spikes. Diesel was always a big driver of it. But now we're getting some of the slowdowns on the jet side, on the gasoline side, on the diesel side, which is, again, putting us below where we have been since 2017 through even 2021, which, as you can see, was a slower year, which obviously COVID was still a thing. People were still looking around, not to say for those that are impacted by it, it isn't, but again, nationally speaking, COVID is not the same impediment that it has been. Now it's more inflation-based. It's more, where do people see the world going, the consumer, and that's where we're seeing some of these headwinds. And we'll talk about that more in terms of pricing. But we don't see that being alleviated. And when you look at a lot of the data so far, you're seeing more and more people canceling trips versus, and we'll talk about this on the Econ show, where the consumer confidence is at the worst it's been on the consumer confidence conference side, because we've talked about University of Michigan. And then there's a key component in there of planning on taking a vacation in the next 6 months, and that's including the summer. And that number has dropped to the levels it hasn't been at since the past recession of the financial crisis. And based on pricing, you kind of get an idea of why, which is here where we're talking about we're just going sideways. There's enough people who are still going to drive because they're like, well, I'm not flying because flying is, outside of being costly, it's epically ridiculous in terms of delays and cancellations and finding your luggage and getting your luggage, that people are like, look, it's expensive. I'm paying for nothing, so I'm just going to drive. So those people are going to, again, keep us there. But the slowdown in global trade, the slowdown in goods, and then the people who normally drive that are just looking at this saying, I have to cut back and my distance just because I can't afford it. That's, again, going to keep us just below that level. So when we look at where we are, last week we were at 14.445 million barrels a day of demand. Currently we're at 14.508. We should get, as we get into this nice little bump for July 4th weekend, we should get to about 15 million barrels a day, and then it'll drop back off. And as we've been saying, we expect to be and hold at about 14.5 to 14.8 million barrels a day as this, like, kind of, let's call it sideways move, just below that average. Because you can see as you get into July, even in 2021, you got closer to about 15.3, 15.5. I just think that we'll be a bit on the sideways front and stay just below 15 million barrels a day of demand. And here's some of the backdrops of the build. So here, when we look at distillate, there was a build of 2.56 million barrels a day, 2.56 million barrels. That's still 29.1 million off the 5-year. But more importantly, when you look at the different backdrops, so Pad 1 had a nice build. The rate of change picked up. We need to see that continue in Pad 1. Everywhere else is fairly stable. Pad 1 is the one that is driving the shortage on a national basis. So we need to see that rate of change pick up. Imports increased slightly by just 1,000 barrels a day. Pad 1 being the driver. We expect Pad 1 to continue to see those imports remain fairly strong as they try to close that gap. But as we laid out in the FSC show, there still remains a big problem in terms of available capacity on the Colonial Pipeline, the Jones Act, getting these cargoes through, because Pad 3 has more than enough product to help supplement what is going into into the East Coast. And when you start looking at where the production is, there is still a significant amount of production as Pad 3 increases their runs. You're seeing that shake out and showing that in more production on gasoline and distillate, which again is going to make more product available, but it's going to be difficult to have that move. And here's just looking at it on a chart basis. You can see just how the rate of change is outpacing in Pad 1 on builds, but you're still at a 29-year low. It's not like you've had this massive rate of change and you're closing the gap quickly. You're closing the gap, but not all that fast. So again, we expect this to continue, but we need to see this accelerate. We need to see more. Now, as demand for diesel and road diesel declines on an economic level, that will absolutely help in terms of getting there, but we really need to see this gap close much faster to be comfortable that there'll be enough heating oil as we get into the winter months. Now, when you look at pad 3, this is what we're saying, where things are fairly stable. Obviously, you had 2020, which is that massive move. We expect it to really hold pretty close to where we are right now, and just go sideways as you get more production. You get exports remaining fairly stable, and we should start to fill this gap right here, kind of staying between that red line and whatnot as we continue to go fairly sideways. And here's where the demand, our view is that we stay below the 5-year average on demand, but above, we're not making new seasonally adjusted lows. It's just we're going to be at the low end of the cloud on the diesel demand front, driven by trucking, driven by some of those shortfalls that we've seen. And here's where we look at market demand continues to fall. We see this putting, as FreightWaves has been talking about, and Craig Fuller has been mentioning, it's going to decimate the smaller guys, the guys that just don't have economies of scale, the ones that maybe sized up, got hired people just to try to capture this massive move from 2020 to 2021. And now we're seeing that fall out, and that's going to put more pressure on some of these other smaller carriers. So we do expect to see bankruptcies. We do expect this to impact things. And then FedEx just came out today and said that expect those surcharges to remain permanent. And when you look at diesel prices, which we do think come down a bit, but are going to stay much higher versus gasoline, that's going to continue to be the case. But again, you're starting to see this come down, and we expect more softening. Again, not a huge drop, but just hanging around this 93 to 95 level as we see some of those slowdowns. It's showing up in the rail traffic as well. We're 3.1% below last year, and you can see that intermodal has continued to slow versus last year. We expect that to continue. This will pick up some of the additional capacity, just because inventories are so high. You don't need that cargo here immediately right now, so you'll wait for the rail. Grain remains at just right at those all-time highs. That's going to stay strong. Coal came down a bit, but again, that'll stay elevated. Farm products, again, all of that. Motor vehicle parts, that's going to stay strong versus last year. Again, things should stay fairly stable versus last year, except the intermodal side, which we do expect to continue to fall. Weather, for those that are watching natural gas, it's going to be very warm from the Gulf of Mexico through the north. You can see essentially the mid-Atlantic down on the East Coast, the mid-Atlantic to Florida, all of the central U.S., but essentially from the Rockies west, you're going to be below normal. But there's going to be enough demand in that corridor, as you can see here, that's going to, again, heat waves, droughts, continuing pressure on crops as well as humans in terms of the needs of air conditioning, while the Northeast continues to be either at or below or slightly below normal. But this will continue to support natural gas consumption. Gasoline stocks, you had a build of 2.65 million. That's 20.3 million below the 5-year. But again, a lot of that is skewed, and you can see it's skewed by Pad 1, which continues to be the biggest driver of the shortfalls of 14.7 million. Imports rose 42,000 barrels a day. Pad 1 had a small drop. We do expect that to come back up to about 700,000 barrels. And it's really because you're trying to pull in as much as you can ahead of July, but the demand is slowing, and that's when you're seeing some of those cargoes being competed for and actually pivoting back up to to Canada and to other areas. As we were saying, on the storage side, we're bouncing back up. You can see that typically on a seasonal basis, you go a bit flat. You see some of the drawdowns start to accelerate Instead, we expect this to go sideways because we do have refiners running harder. We do have imports remaining stable, but we do have demand that's going to be fairly soft, even against 2021 levels, which is going to put more gasoline in storage, which you can see here with gasoline total inventories is tracking 2013 levels, and we expect it to go closer because you can see it bounced off of where we were in 2015. We expect it to close that gap, but the comps are also getting easier. So what we're saying is that the rate of change is going to flatten out. There's going to be small builds, small draws, but it's the rest of those years come to meet you, which makes the comps a bit easier. And here's when we look at Google mobility, TomTom. You can see that things are still below average in terms of where we are on the world level, Europe, Americas. Asia Pacific continues to come up, but we're already starting to see that roll over just a touch. And if you remember from things that we've been talking about, June was the last month where a lot of the subsidies were going to exist. And July, we actually should see some of those start to fall off. So we do expect to see some detriments on demand as we go into July, as those subsidies roll back. And you're seeing it in some of the TomTom data in terms of the activity, where we expect that to slow down, but not so much slow, just stay fairly fixed at these points. Now, when you look at work from home, employees had the most positive productivity experience during the pandemic. Obviously, working at home is becoming, again, not so much a mixture of, well, can you work from home? Is it possible? But what happens if things slow? If things slow and you're the person that refuses to come back to the office and somebody's willing to come back in, you're likely going to get cut. So it's just going to be a matter of permanent work from home and that flexible schedule, where we do think that flexible schedule continues to hold true. And then this was an interesting one. Last week, did you come into the office premise as many days as your employer wanted? And the percent said overwhelmingly no, they did not. But most people didn't say it. Most are coming in days your employer wants you in the office. In work, you can see that most of them are anywhere between that 1 to 4 days, and we expect that to continue to be the case. And then did you come into the business premises as many days as your employer wanted? 82% said yes, 16% said no. Most people are saying nothing right now, but as the things tighten up a bit, we expect that to close. But we do see more of that flexible schedule in terms of the productivity was good when people were home, and obviously on the cost side, it's going to be meaningful to not have to drive as much. So for those that remember way back 2 weeks ago, we were saying that we expected gasoline prices to start to fall, but we didn't expect diesel prices to fall on the same level. And here is that in a chart where you're seeing gasoline roll over. We're now below $5 on the national average, still $4.86. It's not like we're getting a huge saving grace, but diesel is still over $5.50. And when you listen to FedEx, when you listen to a lot of these guys, we don't see diesel really breaking that $5.50 level and really starting to, it'll come down, but really more of a stability place. Right now is at $5.78. We see the floor at about $5.50, and that we expect gasoline to come much closer to $4.75 through the coming weeks, but diesel's the one that we just don't see that same type of drop. Now, blending components, when we look at where it is, blending components had a big build of 4.45 million. That's 14.6 million below the 5-year, but a lot of that is driven by 2020, because we're much closer to the normal 2019. You can see that pink line. We're coming back to 2019 levels. And typically, blending components is a much closer proxy to where gasoline demand is going, where storage is going, because as more of this gets left in the system, you're going to see some of those slowdowns because the blenders aren't as active. They're not pulling down as much. So again, this is why we expect builds to continue in the gasoline market, which again is going to put us closer to where we should be at this point in time of the year. Now, implied gasoline demand, as you can see, remains, and I think it's important to appreciate, what we're talking about here. And I think the chart on the left does a good job with the blue line on 2021, where July 4th was the pivot, where you had that nice step up and then you went sideways. So what we're saying is that you're going to get another pivot and you're going to go sideways. It's just going to be below where we were in 2021 on the gasoline front. And the difference between 2015 and 2019, here you can see on as we've been through 2022, it continues to slip further and further. And again, it's not because of COVID, it's because of price. It's because people are looking at this and saying, I can't afford this. I mean, even me, I'm looking at this, and you're talking to someone or listening to someone who loves to drive. I love driving. I use driving as an escape. If I want to blow off steam, if I want to clear my head, I will go for a long drive. I will go drive along the water. Things I haven't been doing because of this, I've been cutting that back for sure. Just because it's when you look at the price and you see it hit you directly, that's where and you're seeing those numbers play out as we went through March and then obviously into July. And here is it going further back, going to 2012. We are actually currently at 2012 levels. And as we've been saying, we do expect a spike. Like, again, we're going to get demand. We're going to have an increase for July 4th weekend. It's just we're not going to get back to where we should be for that period. Instead, it's going to be that spike and then the sideways move. And here's where you're starting to see that rollover. Workplaces, again, people are taking vacations now. That'll remain slow, so you'll see less, travel for work. As people take vacations in different points, you still have work from home, you still have flexible schedules, and that's going to keep things fairly slow. And then, especially on the retail recreation side, you're actually seeing that dip again, which is just going to be less activity as people go to less stores. Propane. We had a small build of 50,000 barrels, just 8 million below the 5-year average. But the problem is the rate of change. So you can see the rate of change pivoted, and now we're making new seasonally adjusted all-time lows in comparison to some of the key markets or years of 2018, 2017. So again, we expect this to follow the 17, 18 levels. But it's really, we've seen local demand fall, but international demand remain white hot, and we continue to see or believe that to be the case, with days of supply again falling in line with where we were, and we expect this to follow those 2017 levels. Jet fuel build of 350,000 barrels, 1.3 million below the 5-year. Again, as we've been saying, very stable. We're now below where we were for 2021 demand. We expect it to be above 2021 demand, but obviously below that blue 2016 level as we continue to see fairly stable moves. And here's a key reason why. Ticket prices are the highest they've, again, this is seasonally adjusted. So when you look at it, it's the highest they've ever been. This isn't adjusted for inflation, so you can argue that they're not as expensive. But again, whether or not you're adjusting for inflation, $350, $400 for a simple ticket for a family of four, you're going to balk at that and say, well, how much is it to drive again? And so that's where you see those pivots, which is, again, going to keep people stable. You'll still see people drive. It's just, again, going to be below 2019. And as we were saying, you were going to get a little bit of that increase, but we're still going to stay flat and well off of the normal for 2019. And here you're seeing the week ahead just 0.11% lower. So very stable versus the last few weeks. And then as we look at eating out, things remain pretty close to seasonal norms with a little bit of an increase on the weekends and things fairly flat on the weekdays. And we do expect that to continue as, again, retail sales slow. This should slow a bit, but people, again, like to eat out. And we are seeing some slowdown. So typically you get an increase for the summer just because you're going on vacation, you want to eat out, you want to eat outside. We're actually starting to see that ebb a bit. So we should see these slow down just a touch, even though we should be seeing increases for this time of year, especially against these baselines. So that's what we have for you in the U.S. On the U.S. front. In the next segment, we're going to go more global and look at global refined products and global crude movements.